Hello, this is Economic Performance Section A, Gross Domestic Product lecture. Our prioritized standard is Economic Standard 44, and objectively we're going to distinguish between GDP and real GDP. Now, gross domestic product, just called simply GDP, is the total market value, expressed in dollars, of all final goods and services in an economy in a given year. So it's basically all of the things that they have produced, essentially. In simplistic terms, GDP can be determined by adding up all sales of final products. So anything brand new produced that was sold in the country in that year, that is what GDP is, or possibly with some minor adjustments, by adding up all the income that's paid to the factors of production. So all the money that is paid to businesses, individuals, just anyone in the economy, add all that up, some adjustments. That's basically what GDP is. GDP is actually a basic measure of an economic output and is actually used as an indicator of the state of the economy. So in some level, it gives you some idea of how we're doing at this point in time. A country's potential GDP depends on several things, like on the quantity and quality of natural resources that are available. Some nations have more natural resources than others, or higher quality ones than others. The size and the skills of the labor force. Some countries have larger labor force than others. Some have more skillful labor force than others. And also the size and quality of its capital or machinery. So some places have better machinery than others, and therefore that's going to impact your ability to have a higher GDP. Now, GDP is not actually a perfect measure of how well off people actually are. GDP measures the flow of output and not the overall wealth of a nation. So if you look at top GDPs in the world, China is going to be toward the top, but the overall wealth of an individual, that doesn't really reflect that very well. GDP also counts only new, not used final products, not intermediate products. So not every single thing produced in the country is actually counted, because some of those things are going to be a part of a larger product. So like a tire factory, you wouldn't count everything at the tire factory because some of those tires will be put on brand new cars. Also, if anything that's used doesn't count. It's just considered a transfer ownership. They don't count that in GDP. Now, GDP can be calculated using the following equation. So GDP is equal to consumption, meaning all of the things that people buy in the country, plus investment, meaning all the money that is invested in that country that year, plus government spending, meaning all the money that the government has spent, plus net exports, which is your exports, as in all the things that you are producing but selling in other countries, minus your imports, meaning all of the things produced in other countries that we're actually purchasing. Now, nominal GDP is actually stated in current prices. So if you use nominal GDP, an increase in GDP may reflect not only increases in production of goods and services, but it might also include increases in overall prices. So because of this problem, you want to make sure that you're actually producing more from year to year, and it's not just inflation making it look like you're producing more from year to year. So this has led people to adopt a different type of GDP. So GDP can actually be adjusted for price level changes, which results in a statistic that's called real GDP. So generally speaking, when people just talk about GDP, most of the time they mean real GDP, because this is a GDP that takes inflation out of the question. Real GDP actually measures the output of goods and services in constant prices. Real GDP is also considered the most comprehensive measure of an economy's output, since it actually allows different years to be compared in terms of spending value. Using real GDP from different years, economic growth can actually be calculated using this equation. So economic growth is equal to real GDP from a second time period. This is usually going to be the newer time period, minus real GDP from the first time period. So generally speaking, this one would probably be like 2018, and this one would be the information from 2020. 2017. So this one minus this one, and then the number you get there, you divide that by whatever the real GDP was for 2017. In the United States and other industrialized economies, the rate of economic growth over long periods of time have been relatively steady. But short-run fluctuations in business activity are neither smooth nor completely predictable. So this leads us to another concept, the business cycle. Now, the business cycle is a recurring pattern in economic activity that is characterized by alternating periods of expansion and contraction. So when we look at the business cycle, you're going to notice a few things. Generally speaking, you'll hit a peak or an economic peak. And when you hit this point, this is when real GDP actually reaches its high point. So once you've reached your high point, there's nowhere to go but down, which basically will lead you into a period of contraction. On occasion, some people might consider this a bust, like, oh, the economy just busted. Well, it means it started contracting. When you have contraction, this means real GDP begins to decline and business activity starts to actually slow down. And things continue to slow down until they hit the trough, which is the lowest point in the business cycle where real GDP actually stops declining. So once you hit the trough, you can't get worse than the trough. And then if you've hit the worst, then that means you're ready to have expansion or a boom. So if you hear about being in a boom economy, it means we're in an expansion period. And this is when real GDP begins to increase and business activity speeds up. Now, I should point out there's a term that is sometimes used when you have had bad times. Sometimes they will actually call this recovery. When you're starting out, it's just recovery. And basically you stay in a recovery until you've actually reached a point where you are higher than where you were when things started to crash in the first place. So there is no difference between recovery and expansion. It's just sometimes people don't like using the term expansion until they have got back to a point where mostly people are back to work, if we're being perfectly honest. All right, so when we talk about the business cycle, there's a couple terms that are associated with this. Recession versus depression. Oh, and then you hit a peak again, and then basically the cycle starts again, if I didn't say that. So a recession, this is actually when real GDP declines for 2 or more consecutive quarters or 6 months. So here we are, 2007, it was up and then it went down. And then it went down 2 straight quarters. So 6 months of decline. So once this happens, it is officially considered that you are within a recession. And then there's 1 year it went up, or 1 quarter when it went up, but then it went back down. So 1 quarter doesn't negate the fact that it went down for 2 straight. So then it kept going down, then it started to go up, and then it went up, but then it went up for 2. So based on going up for 2, that means, okay, this recession has officially ended here. So that's general nature of how you identify a recession. Now, a depression is actually when a real GDP declines for 2 or more consecutive quarters. So 2 or more consecutive quarters, there you go. And there's another part of it, and real GDP declines by more than 10%. So from top to bottom has to be more than 10% to officially be considered a depression and not a recession. So this was our most recent recession we had, sometimes called the Great Recession. So was the high that it was before and as low as it got, does that translate to 10%? It does not translate to 10%. So basically, when we calculate the rate of economic decline, it was actually only a 3% drop. Compared to the Great Depression in the mostly 1930s, that economic decline was a 26% decline. So that was a huge, massive decline. So it was troubling. It was not good, but it was not anywhere close to as bad as the Great Depression. So again, you have to have at least 10%. This will more than achieve that drop of 10% of economic growth. There are three types of economic indicators that are used to help predict the business cycle. One of those are leading indicators, which are statistics that anticipate the direction of the economy. So one of those common leading indicators we look at to give us some idea of where our economy is headed is actually stock prices. Okay, so this represents the Dow Jones from that same recession that we were just talking about. So stock prices right about this point started to drop. This drop actually happened before the recession actually happened. So when stock prices drop, that's usually a sign that, oh, the economy could be destined for a drop. So this kind of illustrates that that drop is kind of very similar to the actual drop that took place. Other types of leading indicators are going to include things like prices of raw materials, orders for new capital, orders for consumer goods, changes in building permits that are issued. All of those things can be considered different types of leading indicators. Another type of indicator is coincident indicators. These are statistics that change as the economy moves from one phase of the business cycle to another phase of the business cycle. So these are going to be things that happen at the same time as the economy going up or down. Things like personal incomes, sales volume for businesses, industrial production levels and factories. All of those types of things are going to be considered different types of coincident indicators. And the last indicator are lagging indicators. These are statistics that change months after an upturn or downturn in the business cycle. Consumers' use of installment credit, credit cards, the number and sizes of business incomes. Generally speaking, these kind of lag behind. So like if you're talking about business incomes, a business isn't going to know what's happened to their business until it's been going on for a little bit. So they don't always react immediately, so it actually takes a while. So the purpose of a leading indicator is to give you a hint of where the economy is going. Coincident, in theory, tells you where you are. And lagging is basically gives you assurances that, okay, yes, we definitely were in an economic downturn because this would not have happened unless we were actually in an economic downturn. So when these actually start to improve, you can also give economists a hint that, okay, we are officially out of it now because these happen so much after everything else. All right, governments may attempt to reduce the fluctuations of the business cycle by implementing policies that can affect the level of real GDP. Again, that concludes Economic Performance Section A, Gross Domestic Product lecture. Our prioritized standard was Economic Standard 44, and objectively now you can distinguish between GDP and real GDP.